big part of our business is cable contracts. And, the first thing I hear from property owners is, well, we don't pay for the cable for everybody, so we don't really need that service. But the fact of the matter is you do. That's your property, and the cable company cannot serve your residents, their customers, without your permission.
Welcome to the Wealth Through Real Estate Investing podcast, your source for real-world strategies focused on creating long-term wealth, cash flow, and financial freedom through real estate. Through guidance, tips, and stories of highly successful real estate investors and thought leaders, we provide you the tools to succeed and reach the lifestyle you always wanted. And now your host, Dwaine Clarke.
Hello, and welcome to the Wealth Through Real Estate Investing podcast. This is your host, Dwaine Clarke. And today we're going to learn about how to increase your revenue and reduce your utility expenses. Today we have on the show Kevin Gardner of Multifamily Utility Solutions. Kevin has spent nearly 20 years with Comcast, including time as a Midwest Division Vice President of Sales and Marketing and as an Area Vice President. Throughout his career, Kevin was responsible for managing the team that negotiated telecommunication access agreements for cable companies with multifamily property owners. 2007, Kevin started Telecom Marketing Strategies, the parent company of Multifamily Utility Solutions, to fulfill the needs of property owners and third-party vendors to help them better understand the cable operator perspective, maximize their business opportunities, and deliver incremental income. Thank you, Kevin, for joining on the show. And how are you?
I'm doing great, Dwaine. Thanks a lot. Every time I hear that bio, that's 2 times in a row. I think I gotta put it on my to-do list to cut that thing down a little bit.
No, it's great. It's a good segue moving in to kind of give some context to the discussion today. But if you don't mind, just for a few minutes, just kind of dialogue a little bit about your career and more about your company, and then kind of how it segues into the multifamily syndicators and investors that we have listening on the show today.
Sure. Well, I started in the ground floor at Comcast. I was actually a door-to-door sales rep, and actually worked my way up through several promotions, moved around the country in order to do that. And ultimately I was a vice president of sales and marketing for one of their divisions. And part of the responsibility in that role was to oversee the negotiation team that worked with property owners to secure the rights for Comcast to be in those multifamily properties. Did that for quite a while. Company got big, very successful, and great for them. But I don't know, I guess I'm a little bit more entrepreneurial at heart, and I really like to kind of be out there in the trenches doing my own thing. And so I decided to start my own company, and we did that. So initially we were contracted. We were a contractor of Comcast and Charter, and we negotiated on their behalf. They took a lot of that work in-house, and we were like, well, since we know this area so well, what if we go to the other side of the table and help the property owners? And so that's what we did. And, it's been growing ever since.
Oh, very good story. So we had talked a little bit about on the pre-call and regarding the kind of the real benefits of kind of the service that you provide. A lot of people go in there, buy a property and not even thinking about the utilities, the cable, and is how they can actually benefit. They just think that the tenant's going to be paying the bill. Why do I have to worry about it? Can you kind of explain what are the true benefits to multifamily property owners?
Yeah, there's definitely different opportunities in different utilities. As we spoke about, the electric and gas is fairly limited because it's only available in deregulated states. The other thing with that is that it really is based on consumption or usage. And unless you're in a property where you're actually paying for your tenant's electric, sometimes I know all bills paid properties, it's more appealing to them than it is like an A-class property where they're paying their own. So I'll be honest with you, we do maybe 10 to 15% of our business with electric and gas because of those restrictions. The big part of our business is cable contracts. And the first thing I hear from property owners is, well, we don't pay for the cable for everybody, so we don't really need that service. But the fact of the matter is that's your property, and the cable company cannot serve your residents, their customers, without your permission. So a cable company might be given a franchise by the local municipality to operate in that municipality. That's great, but all that does is give them the right to be on the public easements. It doesn't give them the right to be on private property. Now, if I'm a homeowner and I sign up with Charter or Comcast, or I'm sorry, Spectrum or Comcast, I, by signing the work order, give them the right to be on my property to provide me service. In a multifamily situation, the individual resident can't give them the right to be on the owner's property. They don't have that ability to do so. So they have to have a right of entry agreement with the owner of the property. And that's where we come in.
When do you recommend you kind of engage talking with you to kind of find out like kind of these nuances, these different contracts that's going on, and kind of like what's the process for that?
Yeah, the sooner the better, honestly. Even if you're just in due diligence process, you would think that the cable contract would show up in the due diligence process, but I can't tell you how many times it doesn't, because that property, it may be a 20-year-old contract. I saw a contract 2-3 weeks ago from 1976. That was the last time a contract was signed giving the cable company the right to be in there. All it talked about was cable TV. It didn't talk about internet. It didn't talk about phone. It didn't talk about any other services. Clearly, it was outdated, so we had the opportunity. But because it was on auto renew, we had to really dig to find that contract. It wasn't in the due diligence because it was, I want to say, 4 owners ago and 2 or 3 cable companies ago. Because as cable companies sell, every time a transaction takes place, there's an opportunity for documents to be lost in that transition. Not through any intent, any ill intent, but just because that just happens. Every time I move, I lose stuff, right? I mean, it's like, wait a minute, where's my box of baseball cards from 20 years ago? Oh, I must have left it at the old house. The same thing happens with agreements, and that's why we can step in. So even if there's not one in due diligence that's evident, we can look into it with the cable company and determine whether or not there is a valid agreement in place.
And so what about the opportunities there as far as getting money from the utility company, more particularly the cable TV or internet, and how much you kind of can reduce costs? Like, can you explain a little bit about that?
Yeah, it really comes down to it's not an expense savings as much as it is a increasing revenue. There are 2 types of payments. One is called a signing bonus or a door fee. And that is, Dwaine, I'm the cable company. In exchange for you signing a 10-year exclusive marketing agreement with my company, I will give you $50 per door or $100 per door, one time, payable within 90 days of us signing the agreement that we get in place. That's one type of agreement. The other one is a revenue share, which is essentially a commission, and you make a commission based on what your residents take. That's typically paid quarterly, and it's usually a sliding scale based on how well the company's performing. So they're going to give you the incentive to help them get more customers because, as the cable penetration goes up, so does your percentage of revenue. And then there's obviously a hybrid situation. And what we're seeing more and more is that the hybrid is the most popular. When things started out, when this area of the business started out, and initially years ago, they didn't really give any compensation for this. But as things got more competitive, this became more of a need for the cable companies to secure their rights to be in there, so that a competitor doesn't come in and take those rights. So that's why the value is there, and that's why they're willing to pay.
So they're able to kind of what you mentioned, the hybrid. You are able to kind of adjust a different type of revenue, stuff you can get from these cable companies. You mean?
Well, the hybrid is a good model because initially when this started, it was all about door money. They didn't do revenue share. And the simple reason they didn't do that was because the door money or the signing bonus is considered an intangible asset and it hits below the operating cash flow line. The revenue share comes out of operating cash flow. So they didn't like to do anything that would hurt operating cash flow. So it was all heavy on the door fee side.
Mm-hmm.
Over time, what they realized is while that was one goal that was being achieved, once the owners signed that agreement, they had no vested interest in helping them grow their business. I got my money, it's up to you now. So what they did is they came back with a hybrid model with a revenue share that says, look, we're going to give you money for the agreement, but we're also going to give you a vested interest in helping us grow our business. And so the hybrid model came out. So there wasn't too much of a hit on the revenue share, but it's enough of an incentive that owners, definitely have their property managers when somebody new's coming in saying, hey, look, Comcast is your provider of choice, call them because they're getting revenue share from them.
Does this kind of link in, and apologies for my not knowing too much about this. That's why I got you on here as an expert regarding bulk and non-bulk contracts and kind of what that is. And if you can explain that, that'd be perfect.
Sure. There's two. Non-bulk is also typically referred to as right of entry or individually billed service. And that is when the residents pay, they have the option to pick whoever provider they want, take whatever services they want. And the bill is paid by the individual resident with the cable company. They have that relationship. You're out of it. The bulk build is a situation which has become popular. Several cable companies are really pushing this because it's easier for them too. They send one bill. If you've got 100 units, you pay, whether it's cable TV or whether it's internet service, you get a discounted rate, but you're buying in bulk. So you're basically making cable TV or internet service an amenity for your residents. Now, the theory is that if you're paying a reduced rate, you can raise your rent by more than that cost that you're paying, but it's still a lower rate than if the resident were to take it themselves. So let's say the value of the cable TV and internet is $100. The company is charging you $50. You can raise your rent by $75, and you can make some money off of that on the delta there, because the cable company is going to say they want to do it because it's one bill. They know you're going to pay it. They've got all the customers. They're not rolling trucks back and forth and things like that. You're going to be paying a reduced rate. Now you're on the hook for that though. And you're on the hook for every single unit, regardless of whether or not it's occupied. So that is a commitment to you that you've made. And, in many cases, the resident looks at it as a positive and says, well, look, I'm getting $100 of value for 75. So that's plus. The question you have to ask yourself is, how many of my residents are going to find that, are going to think of it that way and say, I'm getting something that's got $100 value and I'm paying $75 for it. That's a good thing. Versus how many may say, well, I don't really want cable TV. I like streaming video. I like Netflix only. All I want, the only value I have is in the internet service. So you're giving me something that I place value of $50 on, but you're charging me $75. So that may be a negative. So you really got to know your market. In some places, it's absolutely a great idea. There's no doubt about it, especially if you're in a highly competitive market where maybe you're trying to bring up your rents in that property. And maybe, you're behind on occupancy and you want to do something to get them, residents, make it more appealing.
Yeah, that's definitely key. You have to definitely look at your particular market, your strategy to see if it makes sense. Definitely see some of the benefits there, because if you're in a very competitive market, you want to be able to offer these amenities that bring in, tenants and be able to kind of ask for, more premium size rents. So that's definitely a great point.
Every property is different. Just like when you go to buy a property, you look at that property for that property, and you can't compare it to necessarily, other properties. You got to look at what's this property about. The same thing holds true with the cable contract. What's the situation? What kind of residents do I have? What's my situation? What's the marketplace like? You got to look at all those things.
Yeah, even on top of that as well, depending on like if it's like a buy and hold long term or like a short term deal where you're just
Right.
trying to extract as much revenue out of it and sell it for maximum amount on the retail market. So it's definitely a lot of different keys that you have to look into, see if it makes sense for you in your situation.
Well, it's funny. That's one of the questions we ask new clients is, what's your long-term goal here? Are you trying to, do we want to heavy up on the revenue share if at all possible? Because do we want to, increase your ongoing, your ongoing profit on a monthly basis and impact your total value, right? I mean, if you can add $2 per unit per month in factor in the cap rate and the value goes up tremendously.
Mm-hmm.
So, what are your goals? Are you trying to get that value up so that you can borrow against it, refinance and take that money and invest in other things? Or are you trying to, get a lump sum of money up front to do, maybe some deferred maintenance?
Mm-hmm.
We had a property owner in Tennessee. They were starting out, they were relatively new in multifamily. And we did they bought a property. They were going to, they sunk most of their cash into it. They didn't have a lot of disposable cash available. So what they wanted to do was get as much money for the cable contract as possible because they were going to be raising the rents to market rate. And they wanted to dump some money back in to do something tangible. It's one thing if you raise the rent. It's another thing if you raise the rent and people see that you're improving it. New owner comes in and they raise the rent $100 and nothing changes. That's not good. New owner comes in, raises the rent $100, and guess what? They redid their pool deck, the whole entire area with the money that they got from the cable contract.
Wow.
That was their objective. So we focused on that. But you're right. I mean, it just depends on the situation, like we're just talking about.
That's a good example that you made there, and that's why it's particularly important during the due diligence stage that you actually find out if that contract exists, that you can actually extract that value. Because if they never knew about it and end up transferring and keeping with the old owner, they want to have that capital available to make that such improvement.
Well, here's another reason to find that contract before you finalize a deal. And I hated that this happened, but this client came to me too late. They already had a deal in place. They sent the cable contract to me and said, what do you make of this? Unfortunately, it was a 10-year agreement that was signed a year and a half ago. The owner was given $10,000 to sign the agreement, and it was a 10-year agreement. Now, if we'd have found that before they did the deal, we would have recommended to them to go back and say, okay, that's a $10,000 for a 10-year agreement, right? And you're absorbing 85% of it, 8.5 years of that agreement. Shouldn't you be entitled to a prorated share of $8,500?
Mm-hmm.
I think the answer is yes.
Mm-hmm. Absolutely.
My client thought the answer was yes, but it was too late in the game. And so the other owner said, well, we already have a deal. So no, I'm not giving that to you.
Yeah, it makes sense.
So those are the kinds of things we can find out for you before, you do your deals. And that's why I say, to answer, it's a really long-winded answer to your question about when should you contact us, the earlier the better.
So what are kind of some other deeper steps, besides, like I said, obviously contacting you to kind of see, where are the opportunities as well, but what are some other additional steps that property owners or people that's looking at purchasing properties that they can take to really see if there's any, opportunities there for revenue?
Well, I mean, on the cable side, certainly it's just make sure you ask for the agreement. And if they tell you they don't have one, let us know, and we'll do our best to see, because we deal with the people from the cable companies. We can try and find out if there is one. They may have one on their records and the owner doesn't. So that's a big opportunity. And sometimes they do. It really just depends on the cable provider, how long the owner has had the property, different things like that. So, I mean, there's revenue opportunities there. Is there with everyone? No, I'd say 50% at least of the properties are under contract, and there's nothing we can do for the owner. But that's fine, because there's no harm for the owner to reach out to us, because here's how we get paid, right? So We'll do all the research, no charge. We will find out if there's an agreement, no charge. We will see if there is an opportunity to do a new agreement. And it's only at the time that if we determine that there is an opportunity to do a new agreement, then that's when we do an agreement with the property owner. And basically that agreement says that we will be paid a percentage of what we're able to get for you once you get paid from the cable company. So if we don't get money for you, we don't get paid. The more money we get for you, the more we get paid. So it's really a win-win situation.
Yeah, it's a no-brainer. It's definitely a no-brainer.
We like it that way. We're commission-only salespeople essentially, and we will. I a couple times a week I find that there is a contract, and I get a copy of the contract for the property owner, and I put it in my database when it's going to expire. And so we'll be in contact so that they don't miss the window, because some of these things will auto renew for 2 years or something like that. You miss a window of opportunity. So we've got our own proprietary database that we've had built that logs every contract we get through here. And we've got, reminders that come up so that we, property owners have a lot to worry about. This is all we worry about is cable contracts, right? So we are reaching out to owners saying, hey, don't forget, we got to give notice. It's a 60-day notice. I usually set the reminder 30 days in advance so that we make sure we don't miss anything.
Yeah, that's definitely key. So I know you guys specialize just on the cable side. I know we briefly talked about other utilities like gas and electricity.
Yeah.
That certain states have, deregulated and, other states are. And I know that's kind of the hurdle. But for the ones that are deregulated, are you seeing some opportunities there, and how can you be able to help property owners?
Yeah, there are opportunities. Again, it just comes down to usage. I think it's 30,000 kilowatts a year that is the usage benchmark. So this is another thing. We do this for free. If you're in one of the deregulated states, all we ask is that you give us your most recent bills. We turn them over to our broker. The broker looks into it and says, can I beat this rate? Can I not beat this rate? And if they can, then you have the opportunity to go with their service. And again, you don't pay anything for this service. So the broker marks up the rate slightly. We get paid, our broker pays us. And whatever rate you're quoted, if it's better than the rate you're paying now, then there's no fee for us, and there's no charge to find out if this is possible for you. We had and we've even had people in due diligence because they're trying to model the property. We had somebody in Illinois, and unfortunately the deal didn't happen, but he had a 60-unit property out there towards Rockford, Illinois. And he sent us he said, look, we're doing a due diligence. Here's the electric bills, the gas bills. What can you do for me? And he was actually pretty excited because we were going to save him, several $1,000s a year on the property. So, he was looking forward to it, but there were some other things that came up through the process and the deal didn't get done. But we can do that. We can help you determine, what it's going to like when you're running it versus what, where the improvements are. And on our website, we've got a list of all the markets where we can do electric and or gas. There's 6 states that have both, 7 states that are electric only, and I think 3 or 4 that are gas only. So it just depends on where you are. Unfortunately, places like Tennessee, as we were talking about, it's a regulated state. There's not a darn thing we can do. The rates are set by the state, and so there's no opportunities there.
That's definitely key there. Thing I like about you is it's like we would say especially in the large property industry, it's all about the team. So like having your attorney, your CPA, your brokers, and having you on that team as well. 'Cause like I said, it all comes down to the bottom line. You're able to see stuff that people that are not experienced and looking at and talking with cable companies, utility companies to find out where those cost savings can be and where opportunities you can make more revenue. So it's definitely key having a person like you on your team. So I really appreciate that.
Yeah, thanks, Dwaine. I mean, my business partner, I own most of the company, but I've got a business partner. He's an attorney. in Ohio, and he's available to me to, bounce things off. And what do you think of this clause? What do you think of that clause? I mean, he can't practice law outside the state of Ohio, but he can certainly give me a legal perspective. And we don't provide legal advice. I mean, we're familiar with these contracts and all those sorts of things. But we do, I've seen so many of these things. I mean, I can't tell you how many, when I was at Comcast, how many of these contracts I actually signed personally. It was unbelievable. And, if you go back, I couldn't even venture a guess as to how many units I've negotiated. It's just been, I mean, it's easily in the hundreds of thousands.
Yeah, so you get that deep experience, like I said, work with the cable company there. So yeah, that's some great information. So how do we get in contact with you? We've got a lot of people that own, multifamily properties, very large units. So definitely would be key to have you on their Rolodex to get in touch with you.
Yeah, the key for us is the number of units, right? So even though technically 8 units is multifamily, the cable companies won't really do much for you there. So the benchmark is kind of 75 to 100. Anything above that. Now, if you've got a 200 unit property and a 50 unit property, they're going to look at that as a combined 2 units at 125. So we can throw the 50 in if you've got something else to leverage with it. The other thing I do is, like for example, now I'm working on properties in Dallas, and I've brought 4 or 5 owners together, all of whom have properties, and we've presented them as a as a whole. So we can gain leverage that way as well. But to answer your question, Kevin at multifamilyutilitysolutions.com. More information there on our website as well. It's just, I love this industry because I get a great deal of satisfaction out of seeing people grow. I was at the same conference 2 years in a row. The first year I spent a half hour talking to a young guy who was just getting into this, and he had just bought his first, I think, quadplex and all that kind of stuff. And he was excited, and he's like, well, can you help me? Can you help me? And I had to tell him, no, I can't right now, but as you grow, we can. He was one of the first people I saw the next year when I walked in, and he's like, in a month, I'm closing on 65 units. Can you help me? And I said, we'll certainly look into it. But it was so rewarding to know that he was thinking about that and see him growing as an investor, and remembering. And so we are more than happy to give free advice because, we're here to build long-term relationships. And we've even told our clients, I would walk away from that deal. I don't think it's strong enough. And that costs us a commission. We don't make anything. But in Louisville, for example, we had 94 units in Louisville 2 years ago. The deal was just not a great deal. It just wasn't. The owner said, yeah, I agree with you. I think we can get more because we're looking to buy more properties in that market. I also brought in another owner that had 132. They had 94. And then they went out and bought 64 more units. Well, a year later, we negotiated on behalf of all 3 of those properties, and we ended up doing a deal. So by doing the right thing a year prior, it benefited all of us more by waiting a year. And that's what we're in. We're in for relationships, long-term, like you and I were talking before the call, right? You want to do business with people you like, trust, and respect. And if you don't do the right thing by your clients, they're not going to like you, they're not going to trust you, and they're not going to respect you, and so that's kind of our mantra as well.
That's love that. So yeah, it was great. I said, really appreciate all the nuggets. I mean, it's really, you gave us so much information. But like I said, the main key takeaway that I got is to get engaged and talk to you, at least from maybe just a homework perspective to see if this even makes sense.
Right.
And then you can take it to the next level to even dig deeper into, because it doesn't hurt to talk to you about it, to even learn about it. And again, turn into a whole win-win situation, because at the end of the day, the bottom line, reducing your utility expenses and increasing your revenue is key in this business. So, and then you're the guy that can help us with that. So Kevin, again, I really appreciate you joining us on the call. I encourage all of our listeners to come give you a call, talk to you about their projects and stuff. And I look forward to seeing you and connect with you soon again at a later date.
Sounds great, Dwaine. Thanks so much for having me on.
All right, thanks and have a great day.
Thanks for joining us on this episode of the Wealth Through Real Estate Investing podcast. Don't forget to subscribe and leave us a review on iTunes or the listening platform of your choice. Also, please check us out at DwaineLClarke.com, as well as find us on Facebook for more useful content and resources.